Hello and good afternoon. I'm really happy to welcome you today and also Mr. Siegel with the Marley Spoon in our roundtable meeting. Fabian, like 10 years ago, Marley Spoon was found, and since then, a lot has happened. And even in the last 12 months, there was um, a lot going on at Marley Spoon. And so I'm really happy to have you here today to get a little bit more insight in your business activities. And for that, I would directly like to hand over to you. The floor is yours.
Awesome. All right. Thanks for having me, Harald, and thanks everybody for joining us today. I think we have a couple of slides that we'll use to give introduction of Marley Spoon, and then we'll open also later the floor for questions where we can go into more details in regards to our most recent results, but also happy to dive into strategic questions, positioning questions, and so forth. As Harald mentioned, my name is Fabian. I started the company roughly 10 years ago. But I have with me a team of great operators, some of them working with me since the very beginning, some of them having joined the last couple of years as the business scaled. Maybe to my person, I've been building direct-to-consumer transactional internet businesses for more than 20 years. This is not the first food-related business. I've been also part of the founding team of Delivery Hero, which is slightly different. It's more like a food delivery platform with takeaway food, but 2014 saw a big opportunity in the next channel switch, which is in the grocery space, and that's where we are today. So talking about Marley Spoon, what are we doing at Marley Spoon? What are the problems we are solving? So at Marley Spoon, we want to promote health and longevity through the right food, while also addressing the problem around food waste. I think more and more people are getting aware that the food that you put into your body, that you eat every day, has a really big impact on your life, on your health, on your longevity. And given that people's time is actually quite limited, we think there's an opportunity to provide a lot of convenience to customers when it comes to nutrition. And there's two kind of areas in our business. One area of our business is the meal kit business, where we make it easy for people to cook. A lot of customers have not really the time to plan the meals for every day, especially during the week. Things can become hectic and people then default eating the same things over and over again. So this is one part of our business, but there's also another part of our business where we are actually sending ready cooked food to our customers that they just have to heat. So these are the two areas of our business. When it comes to the cooking of the food, when you walk into a supermarket, I always felt I could cook anything I like, but I realized when I left the supermarket, I was cooking the same things over and over again. I don't know, steak and broccoli, steak and green beans. And in 2014, we thought, well, why can't we make this easier? Why can't we create a lot of recipes that you just select from and therefore get a lot of variety and very convenience into your weeknight cooking that you do for your family. So we started in 2014 offering 7 recipes every week for our meal kit business. Today, we have more than 100 recipes every week that our customers can choose from. And that's very important because everybody has different tastes, different dietary preferences. And so we can make sure whoever you are and whatever you want to eat, there's just something there that you love. At Marley Spoon, our meal kit business. Similar, if you don't want to cook, if you just want to heat, maybe you're a single household, maybe cooking is really not something you have time for or you want to spend the time on, then we also provide you the option to just heat something and then you are done with. Now, the interesting part why I was so drawn to this industry, and I think it's still 10 years later, today makes me quite excited that when you think about various verticals of consumer spending, the meal kit or the grocery space is the last vertical that's on its way from offline to online shopping. Compared to other verticals, if you, for example, look at fashion or electronics, there's up to 30-40% of these verticals that have moved from offline to online shopping. Whereas in groceries, depending on the regions that you're in, there is actually just between 7, 8, 9% of grocery shoppings that are done online, meaning there is a big adoption still ahead of us that we believe over the next years will provide a lot of structural growth for the entire category. So lots of structural growth given the size of the category. Groceries is the largest vertical, but also it's relatively early in its offline to online channel switch. And we think this is a major opportunity for the business. So starting from the consumer side, what are the trends that we kind of adopt with our service offerings? As I mentioned, the shift to online shopping, again, it's not something new. It's been going on for 25 years, but in groceries, it's probably the last vertical that we will see impacted by that. And so that yields lots of growth. There is more and more emphasis on conscious consumption, food waste, and we'll talk about this in a second, how Marley Spoon as a direct-to-consumer supply chain has a very different waste footprint than traditional food retail. Healthy eating and health and longevity in general becomes more and more a trend consumers are focused on, and recognizing that the food you eat on a daily basis is one of the big influencers when it comes to your well-being, and understanding that processed food and fast food is certainly not what you want to eat if you want to live long and healthy lives, is becoming more and more something consumers need help with. And there is something that we in our brands can provide them too. Convenience is becoming probably the largest driver of adoption for our specific business model. Our customers' lives are very busy, and thinking of what are we going to cook tonight or what are we going to eat tonight is, especially during the weeks, a challenge, and we can help dramatically. And last but not least, customers expect personalized solutions, and especially the taste is certainly something very personal, and you could argue that's the one thing you can't argue with. So therefore, having the ability to serve customers directly, having a direct consumer business gives us a unique opportunity to understand each customer better. And over the past 10 years, we've built a lot of data around our customers, allowing us to provide solutions that are really catered to each of our customers, something a supermarket couldn't do at all because they just don't have this understanding of their customers individually. But talking about supermarkets, there is a question people ask: how can you compete with supermarkets, given that as a business you are much younger than some of these established players? And so certainly also from a scale perspective, these businesses tend to have larger scale and therefore economies of scale. The reason why our business model is very competitive is that we have a very different supply chain compared to traditional food retail. Traditional food retail, as it often deals with perishable items, has the problem that the source to stock, sell from stock model leads to a lot of waste. If you're not forecasting correctly the demand of a cucumber, of eggplants, of vegetables, of meat, of fish in the supermarkets, and remember, you have to do this for each individual supermarket, of which some of these retailers have thousands. If you don't get this demand planning absolutely correct, you have waste. In fact, up to 30% of the ultra fresh items are not being eaten, they're actually thrown away. And if you now remember that 25% of global CO2 emissions come from agriculture, we can realize that there is this waste, and food waste is actually also a contributor to global warming. There's really a very inefficient supply chain that we've built over the years. Now, Marley Spoon's supply chain is very different. We are a direct-to-consumer manufacturing business. We are understanding from our customers and getting orders from our customers a couple of days prior to delivery. That allows us to have a supply chain that's fully made source to order, meaning when the customer tells us 4 or 5 days before delivery what is it they would like to cook, that's when our supply chain finalizes the demand planning and actually sources to a specific order. And as a return, we actually have a food waste that's not 30% of what we're selling. It's actually closer to less than 1%. So we have a dramatic reduction in food waste, and that dramatic reduction in food waste drives a lot of margin and margin strength. So if you compare our profit pool retailer compared to our Marley Spoon profit pool, is that we collapse the brand margin, the wholesale margin, and the retail margin, as we are literally all of that in one go. But then we have the waste reduction and a much leaner infrastructure as we can serve our customers out of centralized warehouses instead of local point of sales that traditional retail businesses have to operate. So overall, that leads to very, very high margin. In fact, over the past years, margin has been moving up and is something around the 30s. In fact, the full year 2020 we finalized with 31.8% contribution margin, which was on the upper end of the guidance range. So every box that we ship to our customers has very high contribution margin. And these high contribution margins drive then high lifetime value, which is then the backbone of an interesting and attractive business model over time. Now, where's the business today? Marley Spoon today, in 2023, we generated around 330 million euros in sales. And we believe we are at the very early start of our growth journey. The company is operating globally. We are generating half of our sales in the US, 30% in Australia, 20% in Europe. And we think there's a couple of growth drivers that we can tap into to achieve our ambition to build a very large business over the next years. Our ambition in the long run is to have a billion euro business at very attractive unit economics and also EBIT margins. Now, there's not just one growth lever to get us there. There's multiple growth levers, which we think it's always important to have multiple options to get to where we want to go. On the one hand side, we do believe there's a lot of structural growth in the industry, as most consumer shopping and groceries is still happening offline. And it's, as we've seen, as consumers discover online shopping as a convenience factor, in other verticals, we see that also in consumer groceries, that there is a lot of growth opportunity ahead of us as the adoption is relatively low compared to other verticals. But we also have an existing business and existing customers that use our service on a regular basis. And compared to other e-commerce businesses, the interesting about food is that it's very regular. Most people eat daily. And so the opportunity to serve our customers on a regular basis leads to very, very high frequency. On average, an active customer in Marley Spoon maybe shops 30 times per year with us. That means we're not shipping every week a box to our customers, but out of 52 weeks, the active customers on average get probably 30 boxes in every year. So it's a very high frequency that we're offering. And within the weekly order that our customers offer, currently on average, we serve them 3 nights. So out of the 5 nights during the week or during the weekdays, or 7 nights during the whole week, we're currently serving only 3 to 3.5 nights for our customers. So there's the opportunity to grow by offering expansion of our services. Over the years, we added more and more choices and we expanded our menu. Every time we provide more choices to our customers, we see our customers increasing basket sizes as they're finding this one additional recipe that they love, that they like. So there's an opportunity to keep growing our offering to our customers by expanding the meals, by expanding the nights we can serve them, by moving into lunch, which we have moved into for a year probably with a market offering, which allows you to add items for lunch, items for breakfast. So there's the opportunity to grow by providing a more comprehensive, convenient nutrition solution to our customers, whether they're cooking or whether they're not cooking. We've recently entered ready-to-heat, which is our second leg of our business, through 2 strategic transactions. We acquired a ready-to-heat company 2 years ago in Australia, and we just announced at the end of January our entry into that market in the United States with the acquisition of Bistro MD, which is the US leading doctor-designed meal plan service in the United States. And so we're happy to bring this brand on to our brand platform. So there's growth in ready-to-heat as an adjacent category to our core meal kit business, where we serve cooking. Ready-to-heat serves healthy nutrition where cooking is not an option, or maybe it's not within the normal use of our consumers that we're targeting. We also believe that there is lots of opportunity to drive consolidation. There's 2 businesses that operate in the same way that we operate globally, being a global meal kit company. One is a much larger company listed in Frankfurt called HelloFresh. And then Marley Spoon would say we are the much smaller brother of HelloFresh, but we are probably the only other global operating meal kit and ready-to-heat brand company that is trading. And so as we've seen the market consolidate, we think there continues to be very interesting and attractive consolidation opportunity, such as the acquisition that we just announced end of January, but we think there's also other opportunities to drive value through consolidation, as we have a platform, a global platform that we think we can leverage across the world. Our core focus of growth probably remains US. US, as I mentioned, is roughly half of our sales. Australia, 30%, Europe, 20%. So that's our overall global footprint. And we see lots of opportunity, of course, in all the regions, but US is probably the more dynamic growth region also in the current environment that we are in. The reason why we think when it comes to consolidation, Marley Spoon is a great or has a great opportunity is there's 3 areas of expertise we think we can leverage. We have industry-leading margins, and we feel, therefore, that our operations footprint lends itself to consolidation. We have a global technology stack that powers our brands, and that is a stack we can leverage across other brands that we acquire. And when it comes to acquiring customers at the right unit economics, we have a centralized marketing platform that runs all brands across all regions, and we think there is an opportunity to leverage that as well. And we've seen early indications of past acquisitions. I mentioned earlier Chefgood, which is an Australian business we acquired 2 years ago. After the acquisition of Chefgood, we did see improvements in acquisition performance, meaning acquisition costs were down, where acquisition scale went up. So normally these things don't correlate that way. Normally, when you scale business and acquire more customers, you also have higher acquisition costs. But the leveraging of our marketing platform allowed us to actually improve performance on the per user cost, but also increase scale. And so that's, I think, good blueprint, and we're looking forward to repeat such blueprint across other potentials that we are looking at, but also when it comes to the recent transaction we just announced. Maybe to come back and sum it up a little bit. So what's the ambition? What is it we want to do? I think the business today is a business that can grow dramatically over the coming years. We have the ambition to build €1 billion in top line at an attractive EBIT profile, but also importantly at very attractive unit economics. There's multiple growth levers ahead of us. And so we, as alluded earlier, there's a lot of things happened in the last 12 months. An important step was that Marley Spoon moved from the Australian stock exchange to Frankfurt last summer. And so we are in the final steps of finalizing this. There is a squeeze out process happening in the first half that will then finalize this process. And so we are just starting to engage with the Frankfurt and European investor bases and starting to talk about the story. So I'm very excited to have a lot of guests here in the room today. Hopefully we'll have some interesting conversations, and looking forward to talk more about Marley Spoon. So Harald, maybe that's a good starting point to slowly move into Q&A. I don't know whether you want to start with the first question or whether we open the floor directly.
Yeah, of course I will. Fabian, as you mentioned, dear everybody, please use the chat box for your question if there are any, and we will come back to them later on. Fabian, as you mentioned just a second ago, the stock moved from Australia to Frankfurt, but maybe you can provide us a little bit more insight. What was the background in the history to be listed in Australia, but now be moving to Frankfurt?
Yeah, for sure. So Marley Spoon was founded in Berlin roughly 10 years ago. We listed the business 2018 in Australia, and the reason for that is that back then Australia was our largest and most profitable region, and we felt there was an opportunity to raise growth capital in Australia, especially in light of a somewhat failed IPO that a larger peer conducted. The company is called Blue Apron, which is not public anymore, but back then in 2018 made it hard to, in light of this IPO, raise capital in Europe and the US. We saw the opportunity to list the company in Australia. In fact, we were the first German company to be listed in Australia. But over the years, while on the one hand side, we successfully were able to grow the business, and excess capital, we felt in the long run it wasn't the perfect market for us, because of the complexity, being a German business and having Australian capital markets law to consider, but also we saw there's more technology peers in Europe. There in Australia, we had primarily mining-related companies, and we felt there's a larger investor universe that couldn't really engage and invest into Australian stocks while they were maybe based in Europe. So we felt it's a more natural listing environment for us to be listed in Frankfurt. We used a somewhat unorthodox method to relist the business because a IPO, given this size of the company, having two listings probably would have been inefficient. So we wanted to move the listing, and we utilized an existing company that was already trading in Frankfurt and used that vehicle to relist, so to say, the business from Australia to Frankfurt. We finished that process in July last year, but we had a remaining stake out of 15%. And that had been over the second half last year, then removed under the threshold of a squeeze out. So by the end of last year, we had moved 95% of the shares into the Frankfurt listing, so that we have just below 5% listing currently left in Australia. And we publicly announced already on Friday, on end of January, that final piece will be then, as part of a squeeze out process, squeezed out throughout H1, and that then will clean the story and finish the delisting in Australia.
Okay, then it will be delisted in Australia. How does it will impact the free float of the new listed companies, so to say, in Germany or in Europe?
It'll improve the free float because we will have basically, we have a very, or after the relisting to Frankfurt, we had a large group of shareholders left in Australia, and we gave them the opportunity to relist at the same commercial terms as already done with the larger shareholders by the summer. And that process is actually concluding as we speak. So we started beginning of February to convert those shares into Frankfurt. And so we're basically moving the float from Australia to Frankfurt. And we've seen also recently maybe that's a reason why the last week and a half, we've seen an uptick in liquidity, because we've seen this float to be moved to the Frankfurt exchange. And so this should increase the free float and the liquidity of the stock in Frankfurt.
Yeah. A question regarding the squeeze out. Has the squeeze out paralyzed? So let's say the Gutachten, has it already been published?
Not yet. So we announced end of January that we expect to invite for the squeeze out General Assembly in due course. That will happen in we expect that this will happen in the first quarter. And of course, this will then be accompanied by the respective auditor reports. There's an independent auditor that's court appointed, and there's an auditor from our side. And so this is in train and will then be submitted to the market together with the invitation to an AGM.
Okay, this process is up and running, and it will continue, and we will expect further news within H1 of this year. So, but let's have a closer look on the competitive landscape. So actually, you mentioned already that there is a consolidation going on. And so one of the questions is, can you elaborate on any consolidation that might happen in the industry? Is there a risk that Marley Spoon will be taken over as well? Or maybe an opportunity? Does not have to be a risk only.
You never know. You never know. I think it's very interesting. We do operate somewhat in a duopoly. And of course, there's our large peer, HelloFresh, who's been in the market a bit longer. The company is a bit older than Marley Spoon. And we've been operating in some sort of a duopoly for, I would say, since the beginning, the last 10 years. When we started in 2014, HelloFresh already was around. And we feel quite comfortable in this duopoly situation because we were always able to position our brands in a slightly differentiated fashion to the larger market leading brands. And we felt that allowed us to acquire customers at attractive unit economics because we didn't have to explain the category. We just explained in the way our brands are differentiated to the category. So I do believe there is a consolidation opportunity for the two global players in the space, which we are the other global player, much smaller. However, when you compare to other public listed peers, we are the largest listed peer in that category. And there is the opportunity for more consolidation, especially as it might be too small for the business that is much greater scale. So I think on our end, we see a lot of opportunity, and the Bistro MD transaction, I think, is a good example where we are able to consolidate the business that can benefit from the cost savings that we can bring to the P&L and can make the business much more profitable. So we can buy a business on very attractive valuations and then boost profitability by leveraging our platform for that transaction. So that's a big opportunity. Now, when it comes to us being consolidated, I mean, that's something it's hard to comment on at this point in time. We haven't received a notice, otherwise we would have notified the market, but it's hard to comment on that. But I do believe there is, I think there's also value in what we're building here over the next years.
Okay, thanks a lot for the answer of this question. Let's stick to the competition, and can you summarize why customers should use Marley Spoon products, both with the traditional cooking and versus other peers, let's say, like HelloFresh?
So our largest competitor indeed is the supermarket. 90% of customers, they don't use our service or brands. They walk into the supermarket and they bring everything home and they use it to cook for their families. And many of those customers realize they cook the same things over and over again. Because in theory, you could cook anything you like when you walk into a supermarket, but then in the end, you default to the same 4 or 5 recipes you keep on cooking. And it might not be even the most healthy options that you want to cook. The benefit of the meal kit is that you have a lot of choice, a lot of convenience. You don't have to actually think about what to cook. You just simply select out of the menu that we provide to you, and you don't have to even bring it home to your house. Everything comes automatically, and you can cook in 30 to 40 minutes. And the best thing about this, it doesn't even cost you more than going to the supermarket. So vis-a-vis the supermarket, the value proposition is very strong from consumers. And that's why we see once consumers have discovered cooking with a meal kit, they normally don't return to the supermarket. Once they get used to our service and cooking, and the magical amount is 6 times. So when you use a meal kit 6 times, there's a 96% chance that you're going to use it another time. So it's really about getting through this habit of forming the habit, the new habit of that weeknight cooking is being taken care of by a meal kit. And so we think we have a really strong proposition over time to take more and more share from the supermarkets. And that's what I call channel switch. You switch from offline to online, and the meal kit can serve weeknight cooking much better. Now, we are not the only meal kit company. You mentioned it yourself. There's a large peer called HelloFresh. Why Marley Spoon? Very simple. Marley Spoon tastes better than HelloFresh. You have no choice. Better recipes, it just tastes better. And that's the best reason, no? Why wouldn't you want to have the solution that tastes better? It also costs a little bit more. It's 3-4% more expensive. But I think this is money that customers who really care about good taste, they are actually happy to go for it. Dinnerly, which is our budget brand, is 30% cheaper. It's similar to HelloFresh. It's also healthy. You also cook good food. It's also as nutritious, but it's 30% cheaper. And we achieve this by keeping the recipe simple, just 6 ingredients, faster to cook. And that is why Dinnerly is differentiated. So we think there is some really good reasons how we differentiate vis-a-vis the market leader. And that allowed us, I think, in the past to grow our business. So that's the reason why HelloFresh. But I think the bigger story really is that 90% of customers that should be cooking with our brands, they still walk to the supermarket and go there and think we have a better solution. That's not only more convenient, but it's also more sustainable because, again, the food waste element, let's not forget about that. 30% of ultra-fresh items are thrown away in the supermarket, and that's terrible from a food waste perspective.
Okay, you got me with better taste and more easy to cook. But as you mentioned that it's taking like 6 times that the customer has ordered a meal kit. Does it depend also how many meals were inside? I know that you have different offering, like for 2 meals, for 3 meals per week, and for many people. So you can say like, I want to cook for 4 people or 6 people. Does it also have an influence on this 6-time order behavior?
So we have different stickiness based on the different plans, but ballpark, they're quite similar. So the ballpark behavior indeed is that you have to, regardless whether you're a family of 4 or you're a group of 2 couples, and whether you want to cook 3 or 4 nights with us, you have to switch your old habit of the supermarket being the source of weeknight cooking into the meal kit. And so we see this sixth order across the various plans as a very important milestone. So it's kind of similar, regardless whether it's 2 or 4 people or 3, 4, 5 times per week cooking. Having this switch of habit is important, and the sixth order is an important point that we see in the behavior curve. If you get to order number 6, again, there's a chance that you have more than 96% chance of the customer ordering another box.
Okay, just a follow-up question, which just popped in. Have you benchmarked HelloFresh versus Marley Spoon with clients, like in the categories of taste, cost, sustainability?
Yes, we benchmark, our customers benchmark us all the time. And so we also hear from our customers. We also both publicly report, and some of the KPIs are comparable when it comes to frequency, when it comes to a number of portions. And we do see that we compare quite favorable on frequency and number of portions. So there is some benchmarking that you can do from the public information, but also we constantly, of course, constantly benchmark with our customers and do brand research on our customers. And again, the choice that we make for Marley Spoon is we really want to position Marley Spoon as the leader in choice variety recipes, because that's the brand promise. Marley Spoon tastes better, and whereas Dinnerly focuses more on better value for money and higher convenience, as the recipes are faster and easier to cook.
Just also another follow-up. How is the current customer acquisition environment relative to how it was last year? So do you see any kind of changes? And when do you think you still start to grow customer count again?
Yeah, so the last year we started quite unfavorably. So in beginning of 2023, we saw conversion rates year over year being down quite a lot, which made it hard to acquire customers. And the reason we believe, and we saw it also in the change in frequency of our existing customers at the beginning of 23 ordered less frequently with us, and which was down year over year frequency by 8% points, which we published when we published our full year results, which improved throughout the year. But again, beginning of last year, people cited budget concerns and value for money as a big reason where they wanted to trade down maybe and buy less often. And we saw when you looked at some of the groceries companies reporting, they also reported a trading down happening. It's probably the canary in the coal mine when people's budgets, when people are concerned about budgets, about high inflation, there is adjustments people make, and food seems to be one of those adjustments that is being made very quickly, because you don't change your summer holiday plans necessarily. You're still going to go on holidays plan, but changing the way you spend your food is like something that you do quite quickly because it's a big amount of your spending and you can change it. And so we saw when we started last year that we had lower conversion rates, lower frequency, and the big drivers we saw in our data was budget concerns and value for money. And we therefore counteracted last year by providing higher discounts to incite conversion rates, improve conversion rates. And while that worked, it had actually a flip side effect that you always see is if the discount is too high, the quality customer or the quality of customer is lower. You get those customers that just look for the deal. They don't want to really stay long run. And so we've seen this marketing efficiency or inefficiency play out last year, and then throughout last year it improved. In fact, frequency was up year over year as of the fourth quarter. And we also saw, as of the end of the third quarter, back the normal marketing efficiency because we had reduced discounts and we saw again these conversion rates we were to see. Now, to answer the question, how did 2024 start? So 24 started on plan, meaning we are seeing a continued stable development when it comes to frequency and when it comes to conversion rates. So definitely better than the prior year. We see higher conversion rates in Q1 24 so far than we saw in Q1 2023. So we see an improvement in the acquisition environment year over year, and we see a somewhat stable behavior that is on plan, which was different than last year. Last year, at this point of the year, we already had seen data that were us not misplanned, that made us misplan. And this year is a much more stable outlook and much more controlled outlook. Now, growth of customers is therefore a function of the acquisition efficiency, but also the marketing spends. And so that's another piece to answer the second question, was when do we expect to grow? It's a function of trading profitability and growth and finding the right trade-off. And we haven't given guidance yet, given that we decided, given that we announced 2 big transactions end of January. And so we're implementing right now all the consequences of these transactions, our planning process, so we can give proper guidance when we're ready with that. So therefore, it's a bit too early to guide for this year. But market growth is a function of marketing efficiency and marketing investment. Marketing efficiency, we feel quite comfortable where we are right now. And marketing investment is a function of trading improved profitability with growth. But I think we said before, this business is a growth business. We expect growth in the business. And growth in the end always then has to be backed also by subscriber growth. Now, you can't just grow basket sizes forever. I think we also, maybe that's to answer that question, we've seen price increases in 22 and 23. We do not expect similar amount of price increases this year. So why I wouldn't rule out price increases, as we still see somewhat food inflation, much lower than in the past. But when you want to grow the business, you've got to grow through your subscriber base. And so as the long-term growth strategy is intact, that means also we do expect to grow on the subscriber base.
Customer acquisition grows, gaining customers, that's really closely related to marketing spending. So looking at your competitive landscape and keeping your EBITDA target in mind, how do you see the marketing spending evolving?
Yeah, so again, it's a bit too early to give guidance, but we said in the past, there's 2 things we need to deliver: profitability and growth, and in that order. But you need both. You can't just have one of the ones. But I think what is not interesting is in an environment where we are operating today with high interest rates, where you have unprofitable growth. I think you need to have profitable growth. We have done great improvements in profit already last year. We've been very thoughtful around our cost. We reduced our cost base quite significantly last year. We therefore improved our EBITDA result last year over year, and we do expect profitable growth, but I think with the emphasis on profitability. And so as soon as we're done, I think with our bottom-up planning, we can give better guidance for the rest of this year.
Actually, there were the question as well, please elaborate how the company will become profitable, but I guess that's something you just have mentioned. And the question, can you give us more specific targets on growth? You mentioned as well that there's no guidance out yet, but how could the more specific details regarding growth could look like in 2024?
Yeah, it's there's 2 levers to growth. There is the organic growth of the business, and then there is the inorganic growth. We just announced a transaction that we closed end of January, so you'll see a growth contribution from this inorganic transaction. But of course, I think the market is also very interested in the organic growth of the business itself. Here, what I said earlier is true, continues to hold true. We do think this is a structural growth opportunity, as the channel switch from offline to online shopping in groceries is still in its infancy. And we've coming from 2 years of very high adoption, 21 and 22. And 23 was a year where we saw the inverse. We saw low consumer sentiment, high inflation, budget concerns, and we saw consumers trading down in groceries. In fact, grocery spendings itself are down, interestingly enough. In real terms, in Q4 in Germany, for example, grocery spendings were down. So we see people spend less money for food, not because they don't eat anymore, but they probably downtraded. And so this effect of consumers downtrading when it comes to food is something that in the meal kit industry, we also experience. And that was honestly also something new. This is the first time an economic cycle has been impacted the meal kit category. The category isn't that old, but or we were fortunate to not have an economic cycle for the last 10 years. So having such an economic cycle was very insightful, I think, for us to understand how consumers behave. But it doesn't change the fact that there's structural growth due to the channel switch and our ability to acquire customers as interesting unit economics. And I think that gives me the confidence, as long as I can acquire customers at attractive unit economics, at a payback of roughly 6 months, which is always our target, and a return of 3x over 48 months, as long as I can spend money to acquire customers at attractive unit economics, I have a structural growth business. I will see my growth business coming to an end when I can't acquire customers at the right CAC to LTVs anymore, because acquisition costs spike up or the lifetime value isn't there. Then I start to get into a situation that you could say, oh, maybe there is the market is satisfied, but that's not really what we're seeing at all. We continue to see attractive unit economics, and we do believe it's a structural growth industry organically in the meal kit space, but also because we have inorganic growth opportunities, of which we just executed one and announced, but there's, I think, other very attractive inorganic growth opportunities remaining. And Marley Spoon, its consolidation platform, has therefore multiple paths of growth. Organic growth, but also inorganic growth.
Thanks a lot for this answer regarding the growth. And another question regarding the customer as well and the profitability, that with the lower level of discounting to the start of 2024, would you expect profitability to be higher this year?
Again, we haven't given guidance yet, but you could see over every year over the past years, we have improved profitability, with 2020 being an outlier because of the pandemic. We didn't have to spend any money on marketing. So there was a strong tailwind that we got. But leaving that aside, you've seen a consistent improvement of profitability. And if you just follow that trend, you would expect that this trend continues in 2024. And without being able to give guides at this point in time, I don't see that trend broken. And so therefore, if you just follow that trend, you would probably expect improved profitability also in 2024.
Yeah. Break even remains a big topic for investors and Marley Spoon. So how much money do you need until the cash flow is positive? And when do you expect to finance your business on your own?
We do have the ambition to operate the business within the balance sheet that we have right now. If you look at the profile, there is the operating cash, and then there is the financing cash. I think Marley Spoon's ambition is to cover its total cash flows. Probably this year, as we move towards profitability, we will be getting then towards the ability to finance having positive operating cash, and we do expect to finance part of our financing cash. We might not have full financing cash covered this year, but we do expect that, especially in light of the transactions we just announced, we have sufficient capital and cash available that will allow us to get to that point as well. So I think we do feel like the transactions we just announced end of January improved the balance sheet significantly. We paid back part of our runway capital facility, so we reduced the debt on the balance sheet, and therefore we do believe we have the balance sheet strength to operate towards that free cash flow break-even point, which I agree with you. That's the one metric that really matters. It is in the end not an adjusted EBITDA figure, but it's generating positive free cash flow yields, and that is something that the company is committed to.
Okay, thanks. So let's go one step back again. A more general question to the market, but do you see a risk from big platforms like Amazon Fresh, offering a comparable or similar product to yours and maybe powered by AI? And maybe you also can give us a little bit insight if you also have an AI topic which is helping you to drive your business.
That's an interesting question, and Amazon has been operating Amazon Fresh for quite a while. And Amazon, I would argue, is the one retailer to rule them all. They're the best retailer in the world. Our business model, however, has a structural advantage vis-a-vis retail because we don't source to stock and sell from stock like as Amazon Fresh does. And in fact, we did used to work with Amazon Fresh. You could buy Marley Spoon meal kits on Amazon Fresh in 2018 and 2019. It didn't work out for Amazon Fresh in the end because they had to throw away all these meal kits they couldn't buy. They couldn't sell. So they sold 1,000 units of a certain recipe, and then they tried to sell them, and the ones they couldn't sell, they had to throw away. So the business model, the flaws of the retail grocery model that yields to high waste makes it very hard to sell meal kits through retail. And that's not true for Amazon Fresh. It's also true to offline retailers, because you have seen similar attempts by offline retailers, be it Albertsons in the US, be it Costco in the US. They all tried to sell meal kits, and none of them could make it successful because they have all the waste. So I don't see Amazon as a retail business being a threat to us. Now, Amazon, because of their money, they can do anything they want. They can just copy the Marley Spoon business model next to what they're doing already. So that, of course, is always a risk. But as a core business, as a core retail business, Amazon, we don't think is amazingly positioned to compete with us. Now, Marley Spoon has this benefit of observing customer behavior. As a direct-to-consumer business, we really know what people like to eat. We observe you. In fact, that's why I mentioned these 6 boxes are so important. After 6 boxes observed, we can actually predict what is it you like. So if you buy 6 boxes with us, after 6 boxes, I can tell you what would you choose out of any hypothetical menu with an accuracy of more than 97%. So
Okay.
I know exactly what each of my customers likes to eat. And by the way, more than 80% of our orders in the second half last year were order number 6 or higher. So the majority of our sales is committed by customers who we know quite intimately. So our machine learning algorithm, and this is not generative AI, this is predictive AI, our machine learning algorithm is capable of predicting for each of our customers what would they like, and that powers menus in the first place. So when our menus get created, which used to be a process our culinary teams were doing, this is not done by culinary teams anymore. This is another algorithm that's actually selecting the ingredients to then create a perfect menu for Sigma active customers to optimize their utility for each of those customers. That's a very interesting optimization problem. It's something that you use machine learning for, because you can't do it manually anymore. So we are benefiting from some of these advanced technologies available to us that allow us not only to predict what each individual customer would like, but to predict what's a perfect menu on a weekly basis to unlock the utility and drive more customer value and higher LTV for the customer. So there's lots of development going. We're investing quite a bit. If you look at last year's CapEx spending, 80% of that was actually going to software. And a big chunk of the software investments were going actually in machine learning and our machine learning infrastructure, because it does drive higher lifetime value for our customers to be able to have our whole supply chain really driven off what predicted customer choice customers would be looking for. So there is a lot of opportunity here to leverage this technology. Generative AI might be a cost-saving opportunity going forward, be it recipe pictures, be it content creation. But for us, predictive AI has been quite impactful already and continues to be impactful going forward.
A follow-up regarding the Amazon topic. Why does Amazon has to order the meal kits in advance, and why doesn't Amazon just collect the orders to get them from Marley Spoon and then to ship them to a customer?
So it depends a little bit on the supply chain model. So the way Amazon Fresh works, Amazon Fresh has local warehouses across the US. And when you buy from Amazon Fresh, you get same-day delivery or next-day delivery, meaning they sell you what they have in those warehouses. At the point of order, when you place your order, it needs to be there. They can only sell you what they have in the warehouse. That means they have to buy it in advance and position it in those warehouses. So they have these forward positioning of stock, and this forward positioned stock sits there and it just ages and it perishes and it has to be thrown away. So the whole supply chain model of Amazon Fresh requires for Amazon to have all the stock on hand so they can then send it to you same day or early next day.
Thanks. Let's go on to another topic. But before, I would like to say, if there are any further questions, there are like 2 left. But if you have further questions, please put them in the chat. And actually, the next topic is Fresh Realm. If I say it,
yes.
Fresh Realm. So the question is, why did you sell the manufacturing assets to Fresh Realm? And how does this arrangement work? And does this harm your contribution margin compared to peers who still own their assets? So the question is,
that's a good question.
I guess that you will be charged for the contribution for the fulfillment, and so how does it impact your business and especially the P&L?
So when we started 10 years ago, none of our peers, for example, HelloFresh, would manufacture anything on their own. They had third parties. And we realized back then, well, customers want choice. They want 7 options. They don't want the same box, everybody, because people are like, not like communism, you tell people what to eat, give people choice. And so we introduced actually manufacturing. We started with manufacturing, and over the years, we're really proud about the manufacturing capacity and capabilities we've built globally. And our peers followed us. They also entered into manufacturing. So back then, 10 years ago, there was no way to outsource it, what we needed. We needed the capability to give a different box to every customer, mass customization. It just wasn't possible. Now, 10 years onwards, the world has changed a little bit, especially in the US. We found with Freshwell a partner, which we've been working already for 2 years, that's building a nationwide platform for convenient food solutions. And when I spoke to the founder of Freshwell, Michael Lippert, we realized, well, if we bring our footprint together, we can actually generate a lot of savings and margin enhancements that in the end, it's win-win. We win, they win, because it is a much bigger manufacturing footprint. So what I feel like 10 years into this industry, we have now the opportunity to go asset light, which has lots of benefits as a business. We didn't go into manufacturing because we just love manufacturing. We learned to love it, but it was just a requirement to provide the customer the solution they needed. But of course, being asset light is much better if you can. Today, especially in the US, we found the opportunity to go asset light without actually impacting margins, but actually expanding margins and reducing cost. That's why we think this was not just a tactical opportunity to sell assets we think we not necessarily need going forward, but also improve the P&L. What does it mean? Well, number one, we will probably reduce the G&A fixed costs through this transaction. So we will lower our fixed costs in the US. We have working capital benefits through this transaction. We, in general, operate in a more asset-light way. And while we do pay a single-digit contribution to our partner when it comes to each product we ship to the customer, we think there is savings that we've identified that should compensate and maybe even overcompensate this. But in the end, we expect not to deteriorate in margin, but maybe see even the opportunity to expand margin of this transaction. And there is, while and sometimes like to take this chip industry as an example, and no, it's a very different industry, but TSMC as a manufacturer has built a global platform of manufacturing, and they're really, really good at manufacturing, whereas other companies like NVIDIA or, I don't know, AMD, they design chips, but they don't manufacture them. So I think as industries mature, you see sometimes industries go in a way where the front end becomes asset light and you have manufacturing platforms that focus on the manufacturing, and each of the respective companies specialize. And I think the food industry or the convenient food industry in the US might be at that stage, and that's why we entered into this transaction with Freshwell.
Talking about your benefits, being asset light, improving margins, why do you think Freshwell was interested in buying your business and the one of Blue Aprons? So what is their idea behind the story?
So the same thing. I mean, they also will make a lot of money on this because they can take a lot of cost out. So they consolidate the two footprints. And so while we save on the G&A side and we save, or we have the opportunity to expand margin as we have more scale, both be it the logistics setup, be it the purchasing setup, they themselves, of course, have also massive opportunities to take costs out and consolidate the industry. And that's why it's a win-win. It really unlocks value that if we would have operated or if we would have continued to operate separately, that value would not have been unlocked because we have then 6 sites instead of 3, for example. You don't need 6 sites for all the brands. You can actually consolidate this. On the logistics side with FedEx and our last mile logistics network, you can just more scale and reduce costs. So there's lots of opportunities to reduce costs by consolidation. And we found with Freshroom, I think, a strong partner that creates this win-win situation where they on their end will make a lot of money by taking costs out, and we also benefit from the asset-light approach and the cost savings.
That was a clear answer, I guess. So actually, there's just a last question, which is a quite interesting one, I would say. What are the largest challenges which Marley Spoon is currently facing that keeps you awake at night?
Yes, so I think there's two questions that I keep hearing from the market and that we are looking forward to prove over the next year. One of the big questions is growth, and we had it here on the call a couple of times. When will the business return to growth on the subscriber base? And for me, it's not something that keeps me up at night, because I do see the structural growth opportunity, and I look at our unit economics and they're quite favorable. But it's something that I know that the market is eagerly looking for, but we as a company, we have to make the right trade-off of also looking at our profitability profile. So we have to take the right time, and rather than rush for growth, we really need profitable growth, and there needs to be the right patience to get this right. So I think that's one of the questions that get in my mind. And the other one, of course, is then the profitability itself. After 10 years, I'm eager to operate a profitable business. We started the company in 2014. And I think there's a saying that every e-commerce company takes 10 years to become profitable. And I always was laughing about this in the past, but then maybe there's truth to this. So I think that's the other thing that doesn't keep me up at night, but it's something that I'm really, really focused on. So I think these are the two areas I think that I'm most focused on. I think 2024 will be an exciting year to start delivering on those. But at the same time, there's going to be a patience required, because in order to hit both, you have to get the timing right. If you just optimize for one of them, you can get one of them very quickly, but you want profitable growth. And so for that, you get the timing right. And therefore for this, you need the right amount of patience. But I think this year will be a good year in delivering on those.
Yeah. Last question just popped up. What is the explanation that HelloFresh is so much larger than Marley Spoon?
So HelloFresh is a bit older, and they were able to raise capital quite efficiently before the Blue Apron IPO. This is one hypothesis. I remember in 2017 when I was raising capital at 7 times revenue. Mm-hmm. And back then we did, I think, 20 million in revenue. And HelloFresh did the same, but they at that point in time were able to raise 400 million while they in capital, while I think they were operating at 200-300 million in revenue. So in a way, our business started much later, and we're very, very small. And I think their access to capital in pre-IPO was quite successful, and they were able to use that for aggressive growth. We had to be much more capital constrained the way we operate. That allowed us to have higher margins. In fact, if you look at the scale that we are at today, we are actually much more profitable than HelloFresh was at the scale that we are at this point in time. So like for like, I think we are currently operating a smaller business, but we're also operating a business with higher margin and higher level of profitability, because our growth path has been just a different one where access to capital was more constrained. I think in the long run, it's not a bad position to operate two companies. Duopoly in food is always, I think, a good area. I always joke, if HelloFresh builds the Aldi of the space, maybe we have the opportunity to build Lidl, which in the end maybe is also a great business. So I think we are both German-based, Berlin-based companies operating the global vision around food. We are for sure the much smaller competitor, but I think we have the opportunity to build also a very attractive equity story.
Indeed, you have. And actually, we're quite happy that you came back to your home turf, let's say, back to Germany, and to be listed in the European markets. That's really a nice and interesting story and an opportunity, and it's as well a kind of tasty equity story, yes. which is kind of rare. So actually, all the questions have been answered, and for that we are coming to an end of our today's session. And Fabian, it was definitely a big pleasure for me to have you as a guest today, and yeah, you will be always welcome to provide us more insights in your growth opportunities.
Great. Thanks for having me, and thanks everybody for dialing in today. Bye now.
Thanks a lot. Bye-bye.
Bye.